Monday, August 7th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADMIS's Senior Financial Economist. Steve, let's talk about the grains and start with what's happening with the funds. Some funds are exiting short grain positions while others are adding to their shorts. What is the state of the grain market, and where do you think the funds think prices are heading?
I think the funds are getting tired of all the volatility in the marketplace. One day we trade the European model, which comes out twice a day, and another day we trade the American model, and they've both been opposite. The American model has been wet, and the European model has been dry. So we've been bouncing around a lot in prices, and really no direction for them to keep on their positions. And then we have this week a USDA report, and usually reports are volatile and exposes them to risk.
When there's not direction for a fund, say in the grains, wouldn't it be normal for them to switch some of their investments maybe into other commodities? Or do they always keep a position long or short in the grain markets?
Well, I think that the index funds always are long grains, and they are whittling down their positions. But the traditional funds follow the momentum of the marketplace, but they could reduce their positions and move somewhere else where the momentum is stronger, maybe in the oil market, the S&P market, or in the gold market.
It seems like crops in the Midwest are split. About 25% of the crop in the West has been dry, while the eastern side of the Midwest has seen normal rains. Corn, soybeans, and spring wheat crops are all rated below average and below last year, but not as bad as 2012. We have a first significant report coming soon. What is the trade looking for?
When we look at the average trade guess going into the report, the averages for corn are much wider than soybeans. We have a 162 to a 169 yield in corn. The government's at 171. So probably the market's trading 165. So you have to be something below that to rally prices, and above it to put prices lower. And there's no real differences as far as the beans. Everybody expects a small decline versus the government's 48 bushel yield. The 25% of the area that's dry is in parts of Nebraska, Kansas, South Dakota, and parts of western Iowa. And they haven't gotten rain all year. But the other 75% is okay. So it's like a third of a drought, which is not bullish, but maybe not as bearish as what we thought earlier. So it puts things in a trading range. In talking to some of the commercials, corn especially, maybe a $3.40 to $4 range. Wheat probably won't trade much lower, but can't rally with so much wheat in the world. And beans could be in a $9.40 to $10 range.
Looking a little further at weather, Steve, are there any other global weather areas that the market is watching right now?
Well, I don't know if we're trading it, but Europe's kind of a mess. We've got Northern Europe, Germany, and Poland's too wet. We're losing quality of wheat. In the south, they've had almost record heat across Spain and Italy, and we're seeing some of the summer crops there deteriorate. Canada's still dry, and so their crop is kind of coming down a little bit, and the Indian monsoon is real patchy. But with stocks so big coming in, it's not a big enough area to cause prices to rally.
Steve, I know last week you were up in South Dakota at the Hefty Seed Ag PhD field days, talking to a lot of farmers. What were some of the questions that farmers were asking?
It was a great time, and it was really focused. A lot of farmers came there to learn. It wasn't a social event, and every one of them came up and was looking for questions about risk management. And every one of them wanted to know what to do with the corn they still had from last year to sell. I mean, the basis out there was 50 under, which means they're getting $3.20 for their corn, and all of them need at least $4 to break even. And there's no real magic formula to go there, but they sort of were interested in some of the seasonals of the grains, harvest lows, January highs, Feb lows, summer highs, to try to take advantage of movements in the marketplace to add to their bottom line.
Yeah, education's still, a key factor to success in not only agronomy but also in grain marketing.
Especially with crops prices below break even.
Alan, let's flip to the financials here. Late last week it was announced that the non-farm payrolls increased by 209,000 in July from the previous month. I think that the expectation was only about 180,000. How does this affect the probability of the FOMC increasing its Fed funds rate later this year?
Well, actually, it did boost the probability that the Fed could raise at the December meeting, but since then, the probabilities have stagnated to some degree. So right now, it looks like there's only a 50% chance that the Fed will raise at the December meeting. My feeling is that they may wait until the first quarter of next year to raise by another quarter. And also, in general, I think the Fed is going to be rather slow to raise rates, but they definitely are on a course to raise rates further.
Looking at the dollar, we fell to a new 13-week low before Friday's rally, and the euro currency last week advanced to a new 2.5-year high.
Right.
What's the outlook for the US dollar and the euro now?
Okay, nothing has changed. The dollar index is probably going to continue to decline as interest rate differential expectations remain negative to the greenback. And the euro currency will probably continue to advance as speculation remains that the European Central Bank may later this year start talking about removing some of the easier credit policies. So continue to sell all rallies in the dollar and buy all breaks in the euro currency.
How about a brief look at the stock index futures? The Dow Jones futures advanced to a new record high on Friday, and also this morning after the stronger than expected employment data released last week. What is the outlook for the stock index futures now? You've been a bullish for a long time, Alan. Do you remain bullish?
Absolutely. Nothing has changed whatsoever. Interest rates continue to dominate, and interest rates domestically are still low enough to sustain the bull market. They're low enough globally for the same results. So buy every break that you see in the indices. This is a trend that will continue at least for the rest of this year in the stock indices.
Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.